Aloha and good afternoon, and thank you all for taking time out of your day. And I want to thank Ashley and JD and the Hawaii Island Realtors for inviting me to share some of this information. My belief is the more I can share with all of you, the better you're all going to be, and give you resources to work with. And I hope that the information that we get today, that we share today, is going to be beneficial. We're going to have breaks in between each of the major topics, and I will answer questions then if you want to use chat to ask your questions. JD tells me that occasionally chat works. Otherwise, people will raise their hand and ask questions that way. So we'll take a break in between each one and we'll go from there. A little bit about me. My name is Carrie Corcoran. I am an enrolled agent, similar to a CPA, but I'm federally licensed. I'm licensed by the IRS to represent before the IRS, and I'm not mandated by state. Similar to you guys are required to register with each individual state. I'm not. I can go anywhere in the country. I have clients across the country. Let's see, I think my furthest one was South Carolina. She finally moved back to the West Coast, but I have people all over the place. At one point, one of my clients was in Saudi Arabia, which was a lot of fun because we had to figure out how to do meetings. But anyway, that's a little bit about me. What we're going to share today, this information is not all inclusive. The IRS guidelines is over 70,000 pages. This is just enough information to share with all of you, to give you some tax updates, how to do your business as a realtor, and hopefully you guys are still seeing my screen. I hope that's the case.
Looks
Good deal.
good.
Thank you, Dana. Then we're going to go over tax changes, the qualifiers of a real estate professional. There are some guidelines and rules that the IRS likes to look at. And then we're going to go into income and expenses of taxes, and then the retirement accounts. Some information that will help you identify ways to save on your business and save for your future. Business registration. JD and I had a side conversation at our Christmas party. Um, let's see, what was that? Back in December, at the beginning of December, about the differences about how you guys are viewed and how you might register your business. As a business, you have a sole proprietor versus an LLC versus a S Corp or a C Corp. Most, I would say, whoops, sorry about that. Most realtors are going to register as a sole proprietor. Some of you might decide to create an LLC. An LLC does not mean that you're an S Corp. It means that you are going to get an EIN, an employee identification number, for the business that is essentially a sole proprietor. As a sole proprietor, your taxes are going to be done on your Schedule C on your personal tax return. It's basically the same thing as a sole proprietor. The only difference about a sole proprietor is you're using your social security number. If somebody asks you for a W-9, you're using your social security number. I don't like that idea. So if you want to create an LLC and get an EIN, that way you're going to give a W-9 that's going to give information out there to everybody that this is your business, instead of sharing your social security number with the world. That just gives me the cringies. As an S Corp is similar to a C Corp, but an S Corp, you're going to use an EIN just like you would in the LLC. They won't give you an S Corp if you're a sole prop. You have to actually make this jump to go to an LLC. An S Corp, though, means you have to start doing payroll. Payroll is a bit of a bugger. I don't even do my own payroll. I hire it out. Somebody does it for me because there are so many little nuances that could go wrong. And then you have to do reasonable compensation. Reasonable compensation for a realtor, you have to figure out, okay, so a part of my day is I'm answering questions. Part of my day is I'm doing bookkeeping. Part of my day is I'm selling houses. How much of each one of those um, elements of your work is worth every hour. So, if I were to answer the phone, I would say maybe, okay, minimum wage in state of Hawaii is $16 an hour. I'm answering the phone at $16 an hour. I'm doing bookkeeping. Okay, maybe I'm doing bookkeeping at $25 an hour. And then I'm doing taxes. So what is my reasonable compensation? That's where S corps get to be a bit of a challenge. Now, C corp is the same way, except C corp is its own individual. It can create a tax return. Both of these have their own tax return. C corp has its own tax return and tax. And if you take money out of the C corp, you get taxed at the dividend rate. Not always beneficial. They say C corps, they're down to 21% tax, but if you took $50,000 and you're going to pay 38% tax on the personal side as a dividend. So these two, they're tricky. You want to really think about doing that. What's the best way to do it if you're going to do it? Looking at my notes here, we have in the state of Hawaii, an individual realtor is allowed to be an LLC, which does allow you to then go to an S corp status. Not all states allow that. So you have to be very aware of the state requirements. That I had to look up because most of the states I've dealt with, realtors are not allowed to be LLCs because the money comes in for your own personal work. They anticipate that it would be your own personal work that's going to be how you're going to report your taxes. So that is pretty much it on your business registration. Any questions? Any chats? Nothing in chat? Nobody's raised their hand. Okay, we can move on. And our next topic is going to be the current tax law changes. And this one is so much fun because people believe they're not going to pay tax on their tips. There are limitations to whether or not they can pay tax on whether or not they'll have a reduction in income for tip income. Maximum is $25,000 per return. Husband works in a restaurant, he gets $25,000 in tips. Wife works in a restaurant, she gets $25,000 in tips. They do married filing joint, they only get $25,000 reduced from their income on tips. Certain businesses are not allowed to do tip reduction, and that would be like me, like you. We're special services trader businesses where our personality, our work is essentially the business. So we're not allowed to take tip reduction. I get tips, but I'm not allowed to reduce my income for it. It gets included in income. These service-related business would be like restaurant, hairstylist, massage, I believe like even the guys that go out and mow lawns, if they get tips, they might be able to reduce their tip income. 2025 is going to be a bit of a bugger of a year to get that reduction in income for tips. We, as tax professionals, are going to be asking for additional reports. How much did you receive in tips? That is actually on your W-2 if you have a W-2 and you're employed by somebody, but that's actually on the W-2. So as a realtor, if you have a buyer who's got a W-2 with tip income, that's extra income. So they need to be aware of how they're reporting that. Overtime is very similar to tip income. The only thing is with overtime, we're really going to be asking employers to provide a report because we don't know how many hours you actually worked on overtime when your W-2 comes through. There's no way to report it on the W-2. Overtime, also the reduction in income is only for the half portion of your overtime. So if you work 45 hours, you get paid a time and a half for 5 hours. That half portion is the deductible portion, not the one portion, not the 1 hour. So there's a little bit of a nuance there as to how we're going to be reporting it. Mortgage lenders, from your perspective, when you're trying to qualify a taxpayer, mortgage lenders may end up with questions as to why, if we're reducing the income for tip and overtime, why isn't that not reflected on the tax return like it is on the W-2s? So they may end up with questions as your clients are trying to get qualified. Tip income is going to be reported, as well as overtime are going to be reported on what we call Schedule K1 or A1 is going to be part of our tax return. So this is a new form on top of the 1040. It gets calculated based on the number of hours, the tips, the overtime, and then the next piece that I'm going to go into, which is really a lot of fun, car loan interest. If anybody bought a car in 2025, as a realtor, we all like to buy cars. I bought a car last year too, but I didn't get a car loan. And the other caveat to this is the car must be assembled in the US. My car wasn't assembled in the US, so my car would not qualify. You have to provide your vehicle identification number, and then there's a calculation as to whether or not you would qualify for any reduction in income from your total income, adjusted gross income. So this one's a little bit tricky. Some people are going to be thinking that they can get a reduction for having a car loan. Maybe they got a car in 2024. That's not going to reduce their taxable income in 2025 because it wasn't a 2025 purchase. It has to be a 25 purchase, US based, and then there's a calculation. You can see there's limits on income, 100,000 if single, 200,000 if married filing joint, anything over 100,000 for single person, no reduction in income. And then the other piece, you may find this as realtors, if you've got any seniors that are trying to apply for a mortgage, they can also reduce their taxable income. Say they get $36,000 in Social Security income, and their total income is $75,000 or less as a single person. They will get an extra $6,000 off of their tax return, off of their taxable income. So mortgage companies are probably going to be interested in this when you've got a buyer that you're trying to get them qualified. As realtors, I'm sure you're always digging, where's that next dollar? Can we get an extra $5,000 in income so that you can qualify for this house? Mortgage companies are going to have a little bit of a struggle for this. So that is the form Schedule 1AC. We're going to see a lot of that this year. They've given us some leniencies for 2025 because they realized that all of this rolled out in the fall. IRS chose not to change forms. They added this form to try and give us a schedule to work off of. But the lenience is for 25. The thing that we know that is going to be probably an audit piece, maybe in 26 or 27, when the IRS starts reviewing these tax returns. Say in 2024, they had $100,000 in income. And then in 25, they said, oh, well, I'm going to take $25,000 and allocate that to tips. So now I only have $75,000 in income. Is that their normal income? Is $100,000 their normal income? Are people playing with this? It's a red flag. It's going to be a red flag. We expect that we'll start to see audits in 2 to 3 years on that piece. It's pretty fascinating stuff. Standard deductions. So standard deductions went up. For a single person, it's $15,750. For a married person, it's married couple, it's $31,500. And head of household is $23,625. Now, the standard deduction gets that additional $6,000 for Social Security if it's a senior individual, 65 or older, $12,000 if it's a couple. The thing about the standard deduction is if we have say we've got $10,000 in property tax, we've got $3,000 or $4,000 in mortgage interest, and we've got maybe a little bit of medical that we're qualifying for, but we don't quite meet the 15,750 or 31,005. It is a high number to exceed before we can start itemizing. People, the majority of my people that can itemize, they own $1 million home and they have a mortgage to match. Or I have a lot of gamblers. Everybody wants to go to Las Vegas, right? I have a lot of gamblers. They go to Las Vegas, they win, they want to be able to deduct their winnings. 2026 is going to be another year we're going to have challenges with winnings because their IRS is going to limit it. Congress wrote into the law that we have limitations similar to our medical deductions. So single 15,750, married filing joint 31,500, high number to reach before you can deduct your mortgage interest. As a realtor, and I've even heard it as when people buy motorhomes on the mainland, if they buy a big 35-foot motorhome and they call it their second residence, they want to write off that mortgage interest. And the salespeople say, oh, you can write off the mortgage interest. But the salesperson doesn't realize that that $6,000 in mortgage interest is a drop in the bucket compared to the 31,500 they get as a standard deduction for a married filing joint couple. So they don't end up getting to write it off. These are some of the things that as tax professionals we end up explaining to clients, educating our clients. I had many clients last year. A lot of my clients are older. They would say, oh, well, I'm not going to have to pay tax on my Social Security next year. I mean, the tax law had not even, it was just being discussed. It hadn't been passed. So I'm like, well, that's not quite true. So we have to do a lot of education. And from a realtor's perspective, all of these affect your client's ability to apply for a mortgage. Any questions? No questions? Y'all are a quiet bunch.
Christy had a question in the chat.
Oh, let's see it.
Do you see that?
No. Tell me what Christy's question was.
Sure. On the car loan interest, does it matter what year the car was assembled in the US? The age of the car? Does it have to be a brand new car?
The original perception was that it was supposed to be a brand new car. So you've gone out and bought a new Ford or a Subaru. Subaru is not going to qualify. Um, Ford Maverick doesn't qualify because it's made in Mexico. It's supposed to be a brand new car. There's some chatter in our professional pages that if it was a 2024 car that was purchased and they've just now gotten a loan in 2025 for that car, that may qualify for this year. Try it for this year. There's some scuttle that we may be able to get away with that this year. Does that answer the question? Kevin's got a question. He's always been told that individual agents in Hawaii cannot be paid by way of their own LLC or S Corp. Only brokerages can. So double checking the information or if there were recent tax law changes. So I did see that you could get an LLC in state of Hawaii. I did look up the law. JD and I had talked about that because that was a question I had for him. Double check that. And that may be something that Ashley may be able to confirm for us from her perspective. Good question, Kevin. Any others? I'm going to keep chat open. Okay. So now we're going to move on to you guys as professionals, qualifiers of a real estate professional beyond getting your license. You've got your continuing education, but if you also hold a part-time job or maybe a full-time job in addition to, because maybe you haven't sold enough homes yet to support yourself, or maybe the market's gone soft a little bit and you've picked up a job. The IRS, Congress has identified that a minimum of 750 hours of service or 50% of your time needs to be able to be devoted to being a real estate professional. If you, have a full-time job, but you sell houses on the side, on the weekends, that is not going to give you your real estate professional status for your deductions. You're going to be limited on how much you can take as a loss each year. Additionally, when it comes down to rental property and material participation, I have couple of clients on the mainland, one that has 16 rentals. They're definitely involved in their properties. They definitely meet the qualifiers, but the qualifiers mean that you have to keep a log of your dates, your work done, hours, total hours for the year. It's important to keep a spreadsheet. One of my clients he does a lot of the REITs, a lot of 1031 exchanges. He doesn't qualify because he relies on somebody to manage his properties. Doesn't get involved other than getting the check, putting the money in the bank. Somebody manages all the money for him. He doesn't qualify. But when it comes, JD, thanks, JD. Mileage. Oh, mileage. Okay, wait. I'm going to back up a little bit, Christy. Thank you for mileage. Mileage for 2026 is 72.5 cents per mile. That's going to be down in the expenses, but we're going to go through that. So good question. Rental property, keeping a log of dates, work done. I've got an example of a spreadsheet here. Time log, time in miles. I like to keep a mileage log as well as a time log. But if I was to talk about on January 22nd, I came here to the office, I discussed a house sale and I signed documents. I drove this many miles, time I left, and how many hours. And at the end of the year, we're going to total this up and we're going to see how many hours it was devoted to being a realtor. Same thing, if I went over to Starbucks, met with Jim Bob to review his contract, how many miles I drove and how much time I spent. This is so that you could calculate your time spent as a professional realtor. If you're trying to justify, well, I have a part-time job, I work 24 hours a week at Target, but then I sell houses, that may balance. If I work 40 hours a week at Target, that's probably not going to fly. One of the other things that I like to do is protect people from IRS audits, get people out of trouble from IRS audits or state audits. We have court cases where people are not able to justify being a realtor if they've got a part-time job. So this log is going to be imperative to help you get through that. On short-term rentals, this log is going to help again on the short-term rental side. Wrong spreadsheet. You're going to need that one later. This one. If I have a short-term rental, say tomorrow I've got, if I go over to Ainaloa and I'm going to go to this street, it's going to take me 17 miles in my time. So I spend an hour, but you would want to document it so that you can keep that information available and protect yourself. I have one of my colleagues, he wrote a book this year. You're going to get all of these notes after the class. I was trying to figure out how to upload it before the class, but we'll get it to you. But one of my colleagues wrote a book called The Ultimate Tax Log. Beat the IRS in your IRS audit. that information. His book is available on Amazon. This is going to be available in the PDF that I'll upload to you guys later. But lots of spreadsheet ideas to keep yourself protected on the amount of hours that you serve doing your business. Short-term rentals. I have a couple of clients that have short-term rentals. 50% of the participation needs to be material in order to qualify for the material participation. Now, all of these apply when we're trying to talk about taking the losses. Of course, there's income limits, but if you want to take the losses on your rental properties, you need to be able to qualify your hours and your material participation. Short-term rentals, they would be daily cleaning, providing towels, providing supplies. Keep a log of what you've done and when you've done it. As an S Corp, in our previous slide, we talked about being an S Corp. Here, you've heard people talk about the Augusta rule. Say you've got a tournament in town and people want to rent out their homes and it's only going to be for a week. They call that the Augusta rule. Well, you cannot rent out your home to yourself if you're an S Corp. That's self-serving. So I cannot, as an S Corp owner, rent my home out to my business for work that I might do. Maybe I'll have a retreat at my home. I can't do that. That's called self-serving. So that is not allowed. That's as an S Corp. Okay, we're about to switch over to a new topic. Questions? No questions. Okay, Christy, we're coming up to your favorite. Almost to your favorite. Helping your clients, first-time home buyers. Can they get additional money for a down payment? Where can they get that money? One of the ways would be as a gift from family. We want to make sure that the family member writes a letter that says they're providing a gift and that it's not a loan to be paid back. Gifts are not income tax-wise to the person receiving the gift. And if the gift is small enough, it was $19,000. If the gift is small enough, then mom and dad don't have to pay tax on that money that they're giving to their son to buy his house either. One other way to get additional money is they're allowed to take $10,000 out of their IRA or 401k, penalty free, to shore up their down payment or maybe to pay for closing cost. This, though, is still taxable income for federal tax and state tax. It just won't incur the penalty up to $10,000. So, a penalty on $10,000, another $100 on their taxes. That's a little bit of help, but they still have to pay the federal tax and state tax on that. It's one way to get more money for their down payment. We still have people coming in. Oh, they missed half of it. There's scuttle being tossed around. We've heard the president talk about it. Congress hasn't enacted yet. He wants people to be able to use their 401ks, their IRAs to buy a home without any tax implications or penalties. We don't know what that looks like yet. Just so you're aware, if people have heard stuff on the news, it's not approved. It's not something that's out there, but it's being discussed. We'll see what he does. Another way for your clients to improve their ability to get a home would be to get a loan from their 401k if they're still employed. Me, I'm employed with my business. I have a 401k. I can ask for a loan from my 401k to help me increase my down payment money or closing cost money to buy a house. And then I'm paying back that loan as I continue my contributions to the 401k. It's me borrowing money from me, paying me back. So in other words, it's a win-win situation if they're employed. Fantastic way to take on more money, and not have it be taxable income. This is a very secure way to fund the purchase of their home and invest and continue investing in their future. One thing that we've heard a lot is whether or not moving expenses are deductible. They're no longer deductible. They took that away from us in 2017. Military can deduct it, but typically military receive reimbursements, so that's not even a benefit there. Any questions? I don't see any questions. Okay, now we're going to go on to Christy's favorite topic. Business income and expenses. Your typical expenses. You've got desk fees, continuing education, travel, meals, small gifts, advertising, website. Maybe you have an accountant. Oh, I have one. Looks like we got a question. I get excited. You say you can borrow from your 401k. Can you borrow from a retirement account? No, you cannot, Donna. Taking money from a retirement account, if it's taken, say you take $50,000 out, and then within 60 days you put the money back in, that works. But you cannot borrow from a retirement account. Okay, back to business income and expenses. My next spreadsheet, I get excited about this one because a lot of my clients use this type of income reporting to me to record their income and expenses. Each month they record their income. Say we have another $10,000 in March, and it automatically tracks their total income. And from that, maybe we pay for an accountant every month. We have bank charges, which could be bank charges, but not penalties. So maybe your credit card processing fees, your bank charges, that can be in there. We can even add in interest expense. And that can automatically be added in. Licenses and GE taxes, dues and subscriptions. Licenses and GE taxes, we like to see these separately stated because we report them separately in the state of Hawaii. Dues and subscriptions, desk fee, I think I already mentioned that earlier, desk fee. And again, I have this cloud of numbers that I draw from when I talk about potentials. None of these are probably anywhere accurate in your costs, but just so you know that maybe somebody's charging you a $600 desk fee and I've thrown 300 in here. I have no idea what it would cost somebody for a desk fee, but I know that they're an expense. You've got your E&O insurance, gifts. Gifts is a pet peeve of the tax world because gifts are limited to $25 per person, or if it's a couple that's bought, it's only $25. So when my realtor bought me a stove as a gift, that wasn't a deductible gift. Maybe he did it another way. Because it well exceeded the $25. But if you buy a bottle of wine for $25, the packaging that wine, you say you buy a bag and then some ribbon and tissue paper and all of that, that packaging is allowed excess of the bottle of wine, the $25. The gift is just that $25. The rest is packaging. Another way around that, though, would be to call it advertising. Say you have a gift, maybe you buy them a fancy Cutco knife, but on it you put your realtor name and phone number and all of that. Consider it advertising, marketing. Um, I didn't put advertising on this spreadsheet. But in advertising, you've got gifts, you've got maybe gifts, or maybe business cards, that kind of information would be considered part of your advertising. But that's one way to get around giving a gift that is in excess of $25 is to buy something, have it engraved with your business information. Maybe, maybe you've created a website. You know, a website is a typical expense as well. I pay more than that a month for my website. But that would be considered a typical expense, or flyers. I would probably put printing of flyers under advertising. I've seen some of my clients put them in as printing. You know, if you've put in a market report, or maybe you've done a big flyer of this house you want to sell, that would be considered a deductible expense. But with this spreadsheet, the reason why this is so important, and your tax person, if you come in and you've typically given them handwritten notes, but all of a sudden you give them this spreadsheet, they're gonna go, yay, praise you. Because you see, maybe you brought in $45,000 this year in commissions and income from your real estate activities,
Yeah,
but
it's
you
really
have,
cool. Thank you.
so
Yeah.
somebody was speaking, but you have $14,285 in total expenses, but then you have to pay self-employment tax, 15.3%. And then you have to pay federal tax. That's a minimum of probably 10% and up. And then you have to pay Hawaii tax. So your total tax out could be, and this is again my cloud of numbers, these percentages, other than this one, these percentages are subject to your total income. So you put 10,842 out on net income of 30,715. Really in your pocket, you've got 19,872. Now, the reason I mention this, the reason it's so important, because in April, June, in September, and then in January, you have to make quarterly estimated tax payments to the IRS and the state of Hawaii for your income. IRS will take this portion in one, and then Hawaii will take their portion in the second option. This is critical. One of my hairdressers that I got out of trouble, she owed like $100,000 to the IRS. The only way to get her to adjust her thinking was that every week she tallied up her income that she earned that week. And then she went and she bought her supplies for the next week. So every week she paid the IRS based on her net income. She calculated it out and paid the IRS on her net income all the way through. That year we got her through without having to pay any tax due. We ended up putting in an offer and compromise. She got approved. She, out of $100,000, I think she paid like $36,000. Okay, let's go with a couple of questions. I see they're popping in, and this is a hot topic, right? A gift amount for 2026 was 19,000 last year. I'm trying to think of, what 2026 came to. Yes. $19,000 for 2025. I think it went to 19,500 for 2026. And now that is per person. So if mom wants to give son 19,500, dad wants to give son 19,500, now all of a sudden he's got $39,000 as an additional down payment that he's received from mom and dad. That's not taxable to him, and it's not taxable to his parents. So he's got extra money. Second question from Christy. What is the gift amount allowed for 2026 per real estate client? Is it still $25? Yes, still $25. Saya, okay. And I hope I said your name right. James. 50%. So we all use our cell phones nonstop, right? We figure this is a business phone. In my world, I've got two of them because the business is on one side and I will shut the business phone off when I need a break. And every night it gets shut off. So 50%, if you have just one cell phone and you've got both your business and your personal on this, only 50% of that bill is deductible. Does that work, James? And JD, we've got another question from Christy. What's the maximum amount you can take out as a loan? That is from a 401k, maximum amount you can take out from a loan on your 401k. That is set by the employer and the employer's plan. It could be because employers have to weigh out how many of their employees are high income, high earning, high paying in versus regular people. They have to weigh that out and report it, and they can't be too heavy on the high end. So it could be 10,000, it could be 50,000. They will have to ask their 401k provider for that number. Okay. So I've gone into estimated tax payments. I can't beat that one to death enough. It's very important that you do that. And like I said, IRS doesn't care if you pay weekly, but you must pay a minimum of quarterly in order to keep yourself out of hot trouble. If this seems like too much work and you don't want to handle it, there is an accountant here in town that's still taking business. I don't have many to offer as far as accounting are concerned, but Anchor Financial, she's accepting business. Again, this information will be in your handout that we'll get out to you guys later. Any additional questions? I'm going to close that one. This is just another screen of, how we're recording the income and potential expenses. It's very important to keep your bank accounts separate, business versus personal. If you have a personal credit card that you want to use for your business, use that credit card only for business. Don't mix them. One of the clients that I represented early on, he ended up owing the IRS over $100,000 because he was mixing the expenses. He took his personal credit card, used it for his business, but used it for personal as well. And then he deducted all of those expenses on the business side. That was a painful reality for him. Painful for me too, because I hate to see clients go through that. So keep those expenses separate. Again, going back to that spreadsheet, keep your income separate just for the business. It's highly important. Looks like Kevin's got another question. I have an individual 401k. You have an IRA, and it's been a great tax deduction to save for my retirement. Yes, that is going to be our last screen. We're about to go there. Solo 401k. All right, Kevin. Good for you. Not a SEP. Not a SEP IRA? Okay, so you're earning income for, yeah, it's a SEP. Okay, you're earning income for today and tomorrow. Today, you're making all your bills, but you also need to know that you want to retire someday. You have several different accounts that you can choose from. As an employee, you can do a 401k, or you can do an individual retirement account, or a SEP for self-employed account, or a Roth. Some organizations, financial organizations, have not yet caught up with the concept of a Roth inside a 401k or inside an IRA or inside a SEP. They're usually a separate account. They're catching up. It's been a provision that Congress has allowed for us for about 3 years. Companies have not yet quite caught up with that. Maximum contribution depends on your age and your net income. Retirement accounts are individual and they are not, you don't have husband and wife in one individual retirement account. It is husband's account, wife's account. Individual retirement accounts grow pre-tax dollars. So as you know, Kevin is saying he's got a 401k. He makes contributions pre-tax from his business into the 401k, and it reduces his net income, which makes less tax at the end of the year. The caveat to IRAs and 401ks is you cannot draw on that money until you're 59 and a half without paying a penalty. Roth accounts, on the other hand, are after tax. So I've brought in $100,000 this year. I want to put in my maximum into the Roth account, and I have to hold that Roth account for 5 years. Otherwise, I pay a penalty. And 59 and a half. So there's a couple of rules there for the Roth accounts. But Roth accounts grow tax-free. I see a lot of my younger generation choosing Roth accounts because they feel like they're going to be in a lower tax bracket now. So they're putting money into a Roth account through their employers, and it's after-tax money, so it's growing and it will be tax-free. That's the caveat to the Roth. SEP, a traditional self-employed, you can put up to 20% of your net income. That self-employed, that net income number that I had in the spreadsheet a little bit ago, that net income of $18,000, you can do 20% of that into your self-employed individual retirement account. It provides a tax deduction on the business side, so it lowers your taxable income on the business. I contribute to my SEP every year. Therefore, my business is reduced in net income. I pay less taxes on the remaining net income. Roth contributions, on the other hand, you can do it through the business if you've got a business Roth account. That helps you on that side. But on the personal side, if you do it outside of the business, there is no tax deduction for that. I don't see any questions popping up because I know this can be a little bit confusing. SEP accounts are for the self-employed. Financial organizations have not yet figured out how to marry the Roth accounts into a SEP. Mine is separate, so I've got two. But be sure to work with your financial advisor. As a tax professional, I have meetings, a lot of meetings throughout the year with my clients and their tax advice or their financial advisors so that we've got a good plan coming together. Financial advisors sometimes will say, oh, let's do this, 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 and this. And then the client will come to me and say, I did this, this, and this. And then I'll go, oh, that means you now have to pay $20,000 in tax because none of that was taken care of when you were doing this, this, and this. So I love to get together, and hopefully your tax professional will be the same way. Love to get together with my clients and talk with their financial advisors to make sure we've got a good plan in place that's not going to hurt them financially. Any questions on that? Okay, I don't see anything coming up. JD, do you see anything?
I'm not seeing any more questions. Hey, everybody, now would be a really, really good time to ask a question. Time's running out. And Carrie's
Time's running out.
she's got lots of good experience and good information, including there's her contact info on screen. Let's see here. We got something here. What do we got here? Dana is asking, is there a max on the SEP?
There is. There is. And as you can see, like you guys probably, there are cheat sheets that we use throughout the year so that we don't SEP education credits, retirement plans. Okay. Standard deduction, 401k limits. Under on SEP, $70,000. Depending on your income, remember you've got the limit of the 20%. So you'd have to have some pretty significant income, net income, in order to support $20,000 or $70,000. Does that answer your question, Dana? I like Dana. She's up there in the front.
Yeah. All right.
Yeah, that's a good goal to have. Set yourself up there to where you can do the max for your retirement.
All right. Well, I think that pretty much wraps up the questions. Anybody else? Last call. Oh, wait. Here we go.
If you buy a
Michael.
gift valued over 25, can you still do it? Yes, you can still deduct 25.
All right. Here we go. Can you explain meal?
Meals. Yes. Meals. Where'd it go? Oh, I lost my meals. Okay. Meals. 50% of the meal. Girlfriend and I, she's a CPA. We go to lunch together. We talk about business. I pay for mine. I only get to deduct 50% of mine. She pays for hers. She deducts 50% on her business. If I take a client to dinner, although I've got clients that take me to dinner, if I take a client to dinner, I get to deduct 50% of that meal, which could be unfair because maybe the client is a couple. Maybe I took a couple to dinner and the meal is $150. I only get to deduct 50% of it. Maybe their portion was $100 and my portion was $50. I get to deduct only 50% of that. If you're out of town and you're traveling for the business, and this is one thing I didn't talk about, traveling for business, I kind of got a chuckle out of my niece. She and her husband are realtors, and we were all here in Hawaii on vacation. And they went to go to an open house. They spent one day at an open house. And they came back to I love Kevin. He's like, no. They came back to the condo and said, um, we get to deduct our trip now. And I handed my niece my card and I said, call me when you get caught. Because that's not how it works. If I take a business trip, the primary purpose has to be for the business. Or if I'm taking a vacation, I get there, I spend a day or two on the business. So 2 days of hotel, my one airfare to get there can be deductible on the business. The rest of the trip cannot. That's out. Last year, I did several business trips, but I incorporated some personal time. I was able to play with that and get it, for the most part, deducted. Meals when you're on business trips are going to be 100%. Now, 2017, they talked about in 2026, they were going to do away with meals altogether. Be aware that could happen. We'll see what they do. I have a client, an out-of-state client, looking for a Hawaii tax advisor to help them with HARPTA. Anyone have recommendations? Not me. I'm full. um, are they selling a home or are they buying? I travel to Oahu all the time and work, but I'm actually visiting my daughter, so I never tried to deduct that ever. Okay, good on you, Dana. You probably could get away with a little bit, but they're selling. Oh, HARPTA and selling. If it's a rental property, they're caught. If it's a primary residence, they could get the money. They could file to get that money back before tax filing. Other questions? Is your mortgage interest still deductible for 2026 as your primary residence? Yes, Christy. However, that falls under the 31,250 if you're married, and what was it, 19 single was 15,750. My mortgage interest doesn't exceed 15,750, so I can't deduct it.
All right. So, wow, that was awesome presentation, Carrie. Obviously, very well thought out. And your experience just shines. Thank you so much. I've got a
Thank you,
couple
JD.
I've got a couple quick announcements really quick here, everybody. Hang with me. So tomorrow, I know we've got a handful of our committee chairs. We're having our committee mixer meeting tomorrow afternoon. Hope to see you there. And our installations next week. Hope you're registered for that. Registration's closed. That's on the 27th. And last but not least, February 12th is our next episode of our Hot Topic series, and that's Elevating Standards for Homes with Catchment. We're going to have multiple presenters for that, and we're going to be hybrid. So you'll have the opportunity to come into the classroom, join with the presenters as they present, or if you want to keep joining us via Zoom, that is good too. So thank you all for attending today and joining, and for all the great questions. And you got Carrie's contact info there. She can help you out as best she can. And look forward to seeing you again, Carrie, at the office. She's upstairs with us here at HIR, and at our other get-together. So if you get a chance, say hi to Carrie if you see her. And everyone just have an awesome rest of your day. Thank you so much.